Welcome to FFS, for finance's sake. I'm Rachael Chadwick Harrison, and with me today is our very own James Monty Montague, our in-house tax expert, as we explore episode 2 of our property series, Smart Structures, How to Not Regret Your Property Investment. So think, if you're going to do this, do it properly. Thank you for joining us today, Monty.
Great to be back, Rachael, to talk about property further and help our clients get a better understanding on property investment.
Thanks, Monty. So let's first explore, should you even do it? I mean, you've got to go through a checklist for viability, haven't you? Do the math. If you haven't already, listen to our previous podcast on how to work out your taxable profit and your cash profit and see if that actually works. So I'm going over to Monty for a few other things that you should be checklisting your property investment for.
Yes, thank you. So whenever it comes to property investment, there's a few things that you really need to start thinking about. Now, the first thing would be, have you stress tested your cash flow at 6 to 7% interest? Now, we know it's not currently at that, but this just allows you to factor it in should interest rates rise in the future. Now, the next thing you need to look at is, can you absorb the cost of items such as repairing the property, non-payment of tenants? You think about how long can you go, how many months could you go by without them paying? And then that will help you determine what steps you need to take should that happen and how quickly you need to resolve that situation. And then the next thing is, are you emotionally prepared to chase tenants for that money should they not pay? Or are you going to be using an estate agent to do it, a property management company? Do you really want the stress of doing it all yourself? So it's just something else to think about, because it's not the best thing in the world trying to chase people for money. It can be quite heartbreaking. So think about the emotional toll it will take on you.
Yeah, it does take a special kind of person to do credit control, doesn't it?
Right, so I've got a few questions then for you, Rachael. What are the tax implications when owning the property in your personal name?
Okay, well, they're different for everybody depending on what their personal income is. So as most people know, you get the first £12,570 of income tax-free, and if you have no other income, no pension, no nothing, then a property investment might not be bad. You're not going to pay any tax on that, owning it in your personal name. But most people tend to have some sort of income, and you've got to take that income and add your property profits to it, the taxable profits that we discussed in the first episode, and find out where that lands. So if all of that together is under $50,270, you're going to pay 20% tax on that property income. But a lot of people who buy property are actually higher rate or even additional rate taxpayers. That's how they've managed to accumulate this surplus cash. And in those cases, they're going to be paying 40%, 45%, or even 60% if they fall into the marginal trap between £100,000 and £125,000. So in those cases, it often doesn't make sense to put it in your personal name.
Excellent, thank you very much for that. So next question then for you. What are the tax implications if you were to co-own the property or co-invest in the property?
So we're talking about tax in joint names there, aren't we? Well, there's obviously a difference between investing with, say, a friend or family member to investing with a partner or spouse. And both really have legal ramifications that you probably should talk over with a legal advisor. We're tax advisors and accountants, not legal advisors. But people often, if they invest with a friend, they can tend to be a little bit more cautious and they tend to put some sort of contract together. They don't with partners and spouses. You should consider having these discussions and what the plan is. Not 100% confident in your relationship, probably don't go into business with them because you're just asking for problems later on. One of the real benefits of doing it in joint names, especially if you are married and say your partner doesn't earn a lot, you can actually structure the legal way you purchase it to benefit you the most. So we've seen people where they buy a property and they own legally 1% of the property, and the wife owns 99% of the property because she's the one staying at home with the kids, and 99% of the profit gets declared in her name because the tax is declared on the legal ownership of the property. You can't just decide to declare it in all or one of the others. It has to be the legal split, regardless of whether you're married or not, and the legal ownership of the property is completely different.
Excellent, thank you very much for that. That was great. Now, so we talked about individually and as partners. Now, what is the benefit of doing it for a limited company then?
So a limited company can be really useful if you are a higher rate or additional rate taxpayer. So you can own the property in a limited company, and then you're going to pay 25% corporation tax on it, which is admittedly a lot better than paying 40+%. And then you can take the profits out as dividends. But equally, you could set that limited company up in a way that perhaps your children have shares. And it's a great way to give the proceeds to them through a legitimate way. They can have their dividends and pay 8.75% tax if their total income's under 50,270. Actually adds to their income for mortgage applications as well, so it can help get them on the property ladder. Lots of benefits from doing it that way. You are going to pay a little bit more stamp duty when you purchase, but for the long-term investment, it can make a lot of sense if you are a higher rate taxpayer.
Excellent, thank you for that. Now, the question I've got for you next is, do you even need to buy, or are there better options with less drama?
Well, it really does depend on what you aim to get out of it. And obviously, property values don't always go up, they can go down. But generally speaking, historically, every 10 years they have increased. If it's a long-term investment, a long-term plan, then I personally think that property can be a good investment if you've got the right place with the right yield. But it's not easy. It's not necessarily the passive income that you might think it is. So you do have to consider, the tenants, the repairs. It can be really stressful if you've got a full-time job and your tenant's ringing you and saying the shower's broke or there's a problem that you've got to sort out. Not ideal to deal with. You've got to be prepared to deal with that. But you can just put it in a fixed savings account and get yourself a set amount of interest. I mean, as we speak at the moment, standard interest rates are somewhere between 3.75% and 4.5%, depending on how long you're willing to lock it away for. The stock market is supposed to be a good investment. Interestingly, there was an article, us in the UK don't invest in stocks naturally. And I think there's a generation of us who suffered with the banking crisis and were afraid of the stock market. And because of that, the Americans at the similar age in their 40s are £150,000 better off because they've invested in the stock market since they were young, whereas most of us have shied away from it. So perhaps it's something to do. Again, not a financial advisor, do take proper advice, but perhaps the stock market isn't a bad option. It can generally return more. Depending on the point you are in your life, actually additional contributions to pension schemes aren't a bad idea. If you don't physically need that money and you don't need it to provide you an income now, if you're doing it for the future, investing in your pension can be a smarter option, especially if you're running your own limited company or you want to offset some of that higher rate tax. If you can do it via salary sacrifice scheme with your employer, there are some really great options, and pension schemes generally grow a lot faster than savings do. They've got very diverse portfolios. Yes, investments can go down as well as up, but on the whole, over the long period of time, they tend to go up, which is why people invest in them. So over to you, Monty, on who should 100% avoid property investments.
Well, as we've already sort of alluded to, when you do a cash test to see the affordability and viability of it for you, if you find yourself in a situation where you're actually like, no, I can't afford to do this, then don't do it. You're just going to be shooting yourself in the foot. You're going to be stuck in a cycle, where you're just bleeding money every month, and it's just not ideal. You're better off looking at other options in that situation.
And I certainly don't advising with a wife if you're having an affair on the side and you don't know about it yet. Risk-reward situation going on. But in all seriousness, if you're in a relationship with someone, perhaps it's new, the time to invest in property is not to mix that with that personal relationship there. You know, you want to wait till you're really settled with a partner before you start making these additional investments. It's a lot of legal ramifications as well if you don't. So Monty, when would you advise that someone should speak to their accountant or, you know, appoint an accountant if they haven't got one, if they're thinking about investing in property?
Well, I would say before you do anything, you need to seek out advice and get somebody to properly look at your financial situation, where your money is, where your income is at, whether it's just you as an individual or you and your partner, and then sit with an accountant, go through all that and make a judgment then on what is the best way for you to both save money on tax in the future, on stamp duty, what do you want to do with that property in the future? You know, in 20, 30 years time, are you going to want to sell it? Are you going to want to gift it to your kids? What is your plans for the future? Best thing to do is speak to somebody before you do any of that, rather than just going off your own back and then incurring additional costs that you hadn't factored in and then panicking about it.
Best advice on this podcast so far, Monty, definitely. So Monty, we have a lot of clients that do property. We have plenty that do one on the side, you know, of a main job. But then we have lots of professional landlords. What would you say that you see them doing differently to people who are just doing it on the side?
Well, professional landlords, you know, they own multiple properties in multiple areas and they normally look after it all themselves. They don't pay anybody else to do it. That is their full-time job. That is their only source of income. They will go and sort out all their properties themselves. Now, this is something, again, for you guys to think about. When you're buying just the one property as a bit of a side hustle, if you like, are you really ready for all that emotional baggage that comes with it, all that extra stress, you know, especially if you're working hard already, and then you really want to finish your normal working day and go, oh, you know, I need to go sort out this property because the wall's been kicked in or whatever the case might be, you know. Do you really want that? That's something for you guys to think about. Another question for you then, Rachel, if I may. If you could just talk to the listeners about what are your biggest pet peeves when it comes to property investment?
Excellent question, Monty, I must admit, and I could rant for ages about my pet peeves. Number one is that they go and they buy a property before they've had any consultation with an accountant. I mean, many of them don't even realise the stamp duty involved. Where, you know, they'll set up their own limited company, think, oh yeah, this is the way to do it, and they'll buy the property, and then they're like shocked at the stamp duty. They don't understand really what they've done. Or alternatively, we've had one recently where they'd bought this property and speaking to them, and they're both additional tax rate payers. They're both earning over 100 grand. I'm like, this is a cash loss situation. And they're like, well, what's your advice? I'm like, sell it. Can't transfer it without incurring the stamp duty again. Kind of screwed. So number one pet peeve has to be not taking advice before you buy the property. Oh my God, just engage an accountant. Just come to us, talk to anybody that knows what they're talking about, pay for that advice so that you know 100% that this is going to work for you. Don't get carried away with, oh, this is so pretty and I can do this. And no, talk to a professional. And number two pet peeve is people that just don't declare this income. It's just crazy. We've had numerous excuses in this office over the years. Oh, I thought I didn't have to pay tax on the first 12,570. Yeah, of your whole income. You've already claimed that in your job. You know, HMRC doesn't give you multiple amounts of this personal tax-free allowance. Yet people seem to think so. And they seem to think that HMRC won't find out. If you're lucky enough that they don't find out for a while, or say unlucky enough, when you sell that property, they do talk to land registry. And they do realise you had a second property and you didn't declare it. And then they're after you for the capital gains tax and the income tax. The mortgage companies are becoming more aware of it as well. We've seen a huge influx in the last 3 years of mortgage companies now asking for your SA 302. So that's to prove that you are declaring this income. And that's when people walk through these doors and say, oh, I haven't declared my income for 15, 20 years. And I'm like, okay, we're going to do a disclosure. Because you can disclose to HMRC, but you're going to pay not only the tax that you owe, but you're actually going to pay a penalty as well. And that penalty does vary depending on whether it was a deliberate disclosure, whether you've come forward, whether it's unprompted, that sort of thing. So if you are renting out something and not declaring it, please do stop immediately. Go speak to an accountant and get that sorted out, get your taxes paid up to date. I must admit, it's my least favourite type of client, because they don't appreciate the work that we do. They didn't want to declare it. They're often being forced to. They've been prompted by HMRC or the mortgage company to do so. And they hate us. Like, we're the evil guys here. But if you'd come to us years ago and spoke about this, we would have made it more tax efficient for you all the way through. So it's a bit of a thankless job, I say, like a bit like payroll. That's a thankless job. Nobody says thank you for getting their pay right. But basically, if you don't understand the spreadsheet of your property investment, you've got no business buying bricks. Well, thank you so much, Monty, for joining us on episode 2 of Property. It's been an absolute pleasure.
Thanks for having me. And remember, guys, seek an accountant before you do anything.